Something huge is happening in the economy on Wednesday, and you need to know about it. The Federal Reserve might actually lower interest rates for the first time in 10 years. And what that means is, as the economic cycle goes up and up and up, since the dot-com bubble, since the Great Recession, and now, we need to be aware of the trends that cause or are related to these recessions. And now we had all-time highs of 6.5% interest rate before the dot-com bubble. We had highs of 5.5% rate before the Great Recession, and now we have highs of 2.5% right now, and you call it the corporate debt crisis, whatever you want. This is telling us right now that as we go into this next cycle where we're going to start lowering interest rates for the first time in 10 years, that our government is acknowledging that there's a major problem here. All right, so today we're talking about interest rates, and the scary thing for millennials and those of us who have saved up money is this idea that the interest rates are going to go down this week. So the Reserve Chairman, Jerome Powell, is expected on Wednesday to reduce the interest rate from 2.5% down to maybe 2.0 or maybe 2.25%. This is a huge problem for all of us because I'm always talking about the doom and gloom, the economy is going to crash, recession. But this is exactly what happens before a recession. The Federal Reserve officially throws in the white flag, indicates that inflation has stagnated enough where they need to resuscitate the economy by lowering the interest rates and stimulating the economy, stimulating consumer spending, stimulated bank activity, loans, financial services, etc. Say you've been wanting to buy that house, you've been wanting to buy that motorcycle, buy that boat for a long time, but interest rates have been a little bit higher than you would like. Well, interest rates are going to get a little bit lower right now, and so it's going to stimulate the economy a little bit more. This is exactly what happens right before a financial crisis happens. It happened right before the dot-com bubble in 2000. They started lowering interest rates from around 6%. Right before the housing crisis in 2008, they started lowering the interest rates from about 5.25% in 2006. And they lowered them all the way down to zero. So we can expect, and effectively within 2 years, the Federal Reserve will have lowered the interest rates all the way down from 2.5 to zero. The thing is, the reason this is scary is because the Federal Reserve never jacked up rates to as high as 5 or 6%, like we saw in the last economic cycles. So what that means is the levers that the Federal Reserve has to control actually aren't that abundant. Basically, that means the levers that they have to pull is just the interest rate and can they print money. And so if they drop the interest rate to zero over the course of 2 years, consumer spending is already really high. Unemployment is super low, spending is high. And if they expect to stimulate the economy more by lowering interest rates, well, that's probably not going to happen. And so if we lower interest rates to zero and the economy still collapses, and people don't come out of the woodwork and start spending money, then we have a real dilemma on our hands. And that's kind of what we're talking about today is what are the what if scenarios if lowering the interest rates doesn't help. So what we can see historically in the stock market is roughly, I would say, 12 to 24 months after the Federal Reserve starts to lower the interest rates, the stock market completely plummets. So we saw that in the dot-com bubble. In 2000, interest rates started to get lowered. And then by 2001, 2002, the stock market was wiped out, all those dot-com businesses as well. Now, as we saw, the interest rates got as high as 5.25% way back in 2006. Interest rates started to go down to, the Federal Reserve started to recognize that the economy was stagnating with preliminary data. By 2007, interest rates were dropping. And then by 2008, the stock market had responded and completely collapsed. And so now we can see that we are almost 12 years into an economic cycle here. since the last recession, which ended in about 10 months or so, in around 2008, 2009. Here we are 10 years later, 12 years later since the inception. The Federal Reserve has not lowered interest rates for the Federal Reserve since 2006. So let's put that into perspective. The Federal Reserve has not lowered interest rates from an economic upswing, from a bull market, since 2006. In 2006, they started to, that was like the last time that they set the interest rate higher. And from there, the interest rate went all the way down to zero. Effectively, I think it was like 0.25%, which is effectively setting it at zero. Now, it's just been ticking up over time. There was almost like 9 years where it was a 1% or less. So the Federal Reserve basically left the economy on high, basically cranked it up, left interest rates as low as it could go. And, we've seen the economy just going gangbusters. So you're asking yourself, I'm a millennial. I've got this money in my pocket. What do I do with it? How am I supposed to invest this right now? Do I keep it in the stock market? Do I do dollar cost averaging? Do I pull out of the stock market? Do I try to time in? What do I do with my retirement? I've got cash. Should I spend it? Should I keep it as cash? So I'm going to give you a few answers right here. Number one, as far as your retirement goes, you've got a few options. One, you could time the market, which is ultra risky. I do that. Basically meaning I'm expecting the economic cycle to end soon. So a significant portion of my retirement, I don't dollar cost average over time. I'm actually putting it in the side in a money market account that tracks Treasury bills. And what that does is essentially it ensures that my money doesn't drop in value when the economy collapses. It's not like investing in gold. It's not like investing in cash. U.S. Treasuries are pretty static at their interest rate. They pay somewhere between 0 and 3%, depending on the day or the year. And so you can pretty much bank on your Treasuries returning not very much. Now, that's a lot better than cash, because if you're holding cash, it depreciates at the value of inflation, which is 2 to 3%. So if you think about it, if Treasuries are paying 2.5% now, and cash is paying negative 2.5% now, if you hold it in Treasuries, you're actually having like a 5% delta gain for just holding your money. So for looking at a place to store cash or value, it's a really great spot. Treasury bills are a great place to put your equity for a low holding cost. Now, I'm not going to do that forever. As soon as the market collapses, I'm going to push that money back into the market at the bottom. And no, I'm not going to invest into a number of stocks, like individual stocks like Amazon or Facebook or Nvidia. Those are some of my favorites. I'm going to actually put my retirement that I had in the money market account in Treasuries. I'm going to put that into a fund that tracks the S&P 500, and that effectively will allow me to capture that delta. So I sell at the top, and then I'm going to buy in at the bottom, and I'm going to, since I have liquidity at the top, I can buy in at the bottom and ride the market up. So that is a lot different than if I was in if my retirement account right now was actually invested in a global index fund, for example, something that tracks the global indices or the US markets. When the economy collapses in a year to 2 years from now, everything's going to just drop. And my investments and my 401k would drop too. So I wouldn't be able to sell out of that and buy into the S&P 500, because if I sold at the bottom, I'd be buying into something else at the bottom. That's why I'm selling out now. That's one approach. It's what I do. It's very risky. I don't encourage you to do it. Don't do it. But I do it. If you want to take a different approach, dollar cost averaging is universally understood as the safest, and passive investing is considered the most highest return, low risk way to go with your investments. So continue to invest every single paycheck into your 401k, into your investments, even as the economy collapses, because you're going to ride that all the way down. And then when you get to the bottom, keep investing. So over time, your money, even though it hits those downfalls, it's always up and to the right. Now, the other thing that we can do with our money when we hear that the interest rate is going to fall is we can think about how is this going to impact the economy as a whole. And the real estate market is going to get just hammered. Right now, we've been seeing inventory, so new homes going in the market, go lower, lower, and lower. The days on the market are going up and up and up. And we've also seen home prices stagnate. I wouldn't say we've seen home prices drop too much, but we've definitely seen stagnation in a lot of locations around the country. What I'm expecting to see is the number of foreclosures and distressed properties really to increase almost exponentially in a very short amount of time. So when I'm talking about preserving liquidity outside of the retirements, if we have cash, if we have investments, if we have investments tied up in stocks, now might be the time to sell those stocks and tie your money up into something, like I said, treasury bills, short-term treasury bonds. I don't mean bonds like corporate bonds. Avoid those. Corporate debt. Do not buy Tesla bonds, by the way. If you've been watching my videos, stay away from them. I know they pay well. Stay away from corporate debt, especially toxic junk bonds. But U.S. risk-free U.S. Treasuries are a great place to, if you sell your stock, buy some of that. And it kind of keeps your hands off your cash. Don't do something like I did. I sold a bunch of stock last year. And I put it as cash in my bank account. Just don't do that. Avoid the temptation, because if you put it as cash in your checking account, your savings account, it's just too easy to get at, and you're going to spend a lot of it. And that's what I did, and I really regret that. But what you want to do is you want to sell that stock that you have now, and you want to have that in an account that you can't touch. Keep it over here. Assets. Keep your assets separate from your spending accounts. Now, when the economy collapses, you're going to move in and you're going to buy these distressed properties. I'm talking about $200,000 homes that are for sale, or duplexes that are for sale right now in the Midwest. I would expect you to be able to pick those up for like 60 to 90K, which is going to be really great. Super small down payment, going in a business partnership with a second person. For that loan, it's going to be 25 to 30% down, so 30K down. Split it $15,000 per person, and you've got a nice duplex somewhere in the Midwest. If you're looking to get a first-time home somewhere in California, prices right now are ranging from, $900 to $1.3 million for kind of a home in the Bay Area, say starter home. The idea is here that prices are leveling off, and when things start to go into foreclosure, you can swoop in when the economy collapses and pick off what's there, what's lying around. And it's going to happen. Expect that to happen within the next year to 36 months. Now, the economy, the stock market will collapse very soon, but the foreclosures will continue to happen in waves, because after the economy starts shifting and the stock market starts shifting, unemployment will rise. So since unemployment's so low, we have to wait now for unemployment to rise. People will lose their jobs because companies will stop selling their goods and services and their products. When the company stops selling their goods, services, and products, they're going to have to make cutbacks. They'll make cutbacks to employment. When they make cutbacks to employment, people will have to spend their money that they have in their savings to pay for necessities like food, mortgage, property taxes, and their car, transportation, things for their children. And once that money runs out, they become desperate and they sell their assets. They sell their cars, they sell their homes. And I mean, this is the class of people who I grew up with. This is the type of people I grew up around. We didn't have much when the economy was bad. We just had to sell things, and that's how it worked. I didn't realize it was part of a systematic reaping of the lower classes and the wealth goes up into the hands of those who have money. Now I'm a person who has saved up a significant amount of money, and I can reflect on society. And not that I even have that much money, it's about just being educated on how the system works. Every 10 years, there's a business cycle. The economy collapses. Those who have liquidity move in, buy the distressed assets, hold on to them until the market's ripe again, like it is right now, and then they're selling those assets. Do you want to know all of the assets that are on the market right now, whether they're classic cars or they're really nice homes on the lake or they're really great properties near the city, and they're selling for outrageous prices? Who's buying them? The people that are buying them are people like you and me who finally feel like we've made it in this world and we have a seat at the table. And so we're taking all of our life savings and we're putting it on the line. And we're using our collateral, which is our job and our savings, and saying, I'm good for it. Now, what's happening on the other side of that table is the wealthy people who picked up all the pieces in 2009, 2010. They sat on those assets that we're buying. They sat on those assets for the last 10 years, and they watched them. They watched them grow and grow and grow and grow, and they got like a 3 or 4x or 5x multiple. Well, everyone else just got your regular, 100% return over the last 10 years. They got a 500% return on all those assets. And now they're selling out at the peak, and all the lower and middle class people who are excited for their material wealth and to show off their wealth that they've accumulated, they're putting themselves into debt, and they're buying all of these assets, and it's just an exchange of money for goods. And the wealthy are now completely wealthy in liquidity, less on assets. So on the balance sheet for the wealthy people, they're really heavy in liquidity. They're low on physical assets. For the middle and lower classes, they're very, very high on physical assets as far as their balance sheet, but they're very, very low on liquid capital. They're working hard, maybe 60 hours a week. They also carrying a lot of debt on the balance sheet. The wealthy classes, upper classes, upper middle classes, they've lowered the debt on their balance sheet. So now they're in a really great position for when the economy collapses. These people here will lose all of their material goods. They're going to default on their debt, and they're going to have to sell it in a distressed state to the wealthy people who will take it for a fraction of the cost. So all of this really has to do with what's going on Wednesday when Jerome Powell, the chairman of the Federal Reserve, announces that the interest rate is going to be lowered for the first time. That means that banks will now be offering loans for cheaper interest rates than they had before. That in turn is supposed to trigger more economic stimulation. But that's bad for us because it's a warning sign that the highest bank in America says that the US needs more stimulation. And for the last year, it's been the exact opposite trend where we've been raising interest rates to slow things down, to make everything more stable. Now they're raising the red flag and said, all right, we got to stir this up. We got to make sure we stimulate this economy. And in doing so, it's actually just a warning sign that worse things are to come. It's a warning sign for us to get our financial houses in order. If you like what you heard today, hit the subscribe button below. If you really like what you hear, hit the notification icon as well. See you next time.